want to welcome everyone here because this might not be the normal video that because you learn a lot. Thank you so much. Now, guys, don't skip any part of this video. Make sure you watch it to the end. Gain the knowledge, gain the understanding, and then don't forget, if you have not subscribed to this channel, do it to subscribe to this channel. This is the Wychoff market cycle method. The Wychoff market cycle method. Now I want to teach you on this. Now don't forget to subscribe, don't forget to click the notification bell so you'll be notified whenever I upload a video such as this, every video such as this. Well, because most people don't teach this because they don't know, so they don't teach it. Now I'm doing this because I want us to learn. Now Wyckoff is actually one of the men that played crucial role in the forex market. As far back 90s, he played a crucial role, and actually he offered a systematic way to understand how market moves based on the action of large institutional players, which we call them the composite men. We call them the market makers. Now he actually explained that market moves in predictable phases, and then they are being driven by supply and demand dynamics. He talked about supply and demand dynamics. He also talked about price movement, and then he talked about the trading volume pattern. Now with these three methods, he applied them across the market, and it worked both in the crypto market, in the stock market, and in the forex market. So now this video is a 3-in-1 video, even though I'm doing it in forex chart. You can see that this is GBP USD. I'm doing it using a forex chart, but that does not mean that you cannot apply it to your stock, to your crypto. Meanwhile, you know that this is both a channel for crypto and for forex. So if you want to learn more about crypto, you can actually go to the crypto playlist. We have the crypto news, we have the beginners in crypto. You can learn that crypto from that aspect. Well, this is a playlist for forex, and then strictly for forex. You learn forex, you learn from beginners to advanced, you learn strategies, and then you will be able to trade well in the forex market. Now let me move on. Now Wyckoff actually gave us some stages of the market cycle. We have some stages of the market cycle, and these stages are actually four. These stages are actually four, and let me use my board. Now we have four of these stages. Now the stage one is what I call the accumulation stage. distribution stage. Number 2, we have the markup phase. Number 3, we have the distribution. And then number 4, we have the markup. The markdown phase. Now, these are phases in the forex market that Wyckoff was able to identify and explain: the accumulation phase, the markup phase, the distribution phase, and the markdown phase. Now, I will be explaining them bit by bit for us to understand what these phases are, and I want us to follow gradually to understand what these phases are. Now, I want to start with the accumulation phase. I have explained in a video before this particular video, in my last video, a little about accumulation, and I said that the accumulation phase is actually a quiet phase. The accumulation phase is actually a quiet phase whereby big institutions are in the business of buying without announcing their buying. Now look at it, you see accumulation phase. Now when you talk about accumulation phase, you're talking about this tiny movement. Now institutions are actually buying gradually. You see, they bought and people were thinking that they were not actually in the market, but they were right there in the market buying and making transactions until there was a big move to signify that the big guys are around. Now these are the accumulation phase. Now when you see market moving in a sideways pattern without big movement, without momentum, volatility, it is the big boys doing what we call the accumulation phase. They are in the market, but they are buying gradually. They don't want to announce their presence. Now you see the business, they are performing the business gradually without announcing their presence. Look at it. Without announcing their presence, they are doing the business what? Silently. Now they buy this, like for example, look at this place here. Look at this particular place. They bought this, they were buying, selling gradually without people knowing that the big guys are around. And then look at their own particular structure, then look at what happened. There was a move. Now this accumulation phase has to do with big investor quietly buying gradually after the price has fallen, causing price to stop falling and to move in a sideways pattern. And this is a clear example. You see, after price has fallen down, it moves in a sideways pattern, forming like a support. Now this is what we call the accumulation phase. They are there buying gradually, positioning themselves without you knowing. Now for you to be able to know that it is an accumulation phase, you will see that price are clusters together. Look at here, to price clusters together, here to price cluster together. That is just a clear indicator that is actually a clear indication that you are in an accumulation phase. Like the word implies accumulation, that means they are gathering contract. Look at an accumulation here happening. Look at here, this particular place. You discover that it is accumulation. Market makers are accumulating. They are accumulating what? Contract. You see it here. They are accumulating contract before we saw the massive movement. But this particular place is called the accumulation phase. The accumulation phase. Please at the back of your mind. When you see price moving in a sideways manner, when you see price after a big move, it begins to stay in a particular position, you know that the market makers are accumulating something. They are accumulating something. Now, after this, the second phase is our markup. Now, the markup is that price rises steadily as demand outpaces supply, attracting more buyers in the market. Now, let's go for to explain it as regards buy. Now, look at what happened here. You discover that after the accumulation phase, now we come to the markup phase, and in the markup phase, now this is the markup phase. Now you discover that price rise steadily as demand outpaces supply, as demand of that particular pair is greater than the supply in that particular pair. Now it moves in a steady manner. Look at it. It's buying and going. It's buying and going. You can even draw the line. It's buying and going. Now you can clearly say that this is actually in an upward trend. It's buying and it's what? It's going. You see it. You can clearly say that it is in an upward trend. The price is steadily. Now this is now the trend. We can say this is the trend. Now the markup phase is actually price moving in direction of the trend. The markup phase, like I said, is price moving in direction of the trend. Price moving in direction of the trend is the markup phase. Now the markup phase is always the best phase for you to trade. Put it at the back of your mind. The markup phase, either bullish or bearish, is actually the best phase for you to trade. I don't expect anybody to trade during the accumulation phase, because the accumulation phase, there's no much volatility in the market. Look at this. Look at this. This price movement is actually the markup phase. Is actually the markup phase. Now you see price now moving in direction of the trend steadily. Price is moving steadily. Price is moving steadily. Price is moving. Now that is the markup phase. Now during the markup phase, you should watch out for higher highs and higher lows with increasing volumes for you to enter your trade. Make sure you watch out for higher highs and higher lows. Now these are higher highs, these are higher lows, these are higher high, these are higher lows, higher high, higher lows, higher highs, higher highs, higher lows. Now watch out for what? Higher high and higher lows. You see it? High and low, high and low. Now you want to enter this particular trend or this market, you wait for what? Higher low, and this is the higher low. This is higher high. Now once price move up, you wait for what? A pullback. Now the pullback is what makes the higher low, while the price continue in direction of the higher high, then you wait for it to pull back to the low, the higher low, so that you can look for entry. It will definitely go up again, wait for pullback, then you look for entry to go up, and then you continue waiting for entry. Now you discover that in this short possible period we have gotten 1 entry, 2 entry, 3 entry, 4 entry, 5 entry, 6 entry, 7 entry, 8 entry. You can imagine this is 1, 2, 3, 4, 5, 6, 7 days. Now 1, 2, 3, 4, 5, 6, 7 days. Now within these 7 days, now if you notice, each of the days we have an entry point. You see it, each of the days we have an entry point, 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 we have an entry point. Now as price moves, making the higher high and higher lows, so also you are positioning yourself in order for you to make profit in the market. Now the advantage of this is that you know that price has finished accumulation period. Now you are now in the trading period, which is the markup period, and then you are looking at how price will go in that direction for quite a long time, and you can verify now price has been going in this particular direction for more than 5 days. For more than 5 days price has been going in this particular direction, signifying to you that this is actually a markup period. This is actually a markup period. Now after we have understand the markup, now the next for us to understand is the distribution phase. Distribution phase, we have what we call the distribution phase. Now what happened here, market makers or big investors sell their shares to retail traders waiting to buy at what? At high prices. They sell their shares, they sell their shares to what? To retail traders, and then they are waiting to buy at high prices. Now this is how the market moves. Now for you to understand this, you need to watch out for prices from a sideways range but with signal of weakness, such as false breakout. That is when you are going to understand this distribution what phases. You are going to understand this distribution phases, but you need to be very careful in this distribution phase because of buying in this range. Why? Because sellers are actually preparing to sell. So when you see this, you need to be careful. If not, you might enter at the wrong time and you don't have a lot of equity for you to withstand the little sell, and before you know it, you get stuck. Now what is this particular distribution that we're talking about? This small cell, as we are going down, where we're going up, this small cell, this particular cell, this small cell, this small cell, this small cell, the small cell that gives us opportunity to buy again. This small cell is what we are talking about. This tiny cell, they are what we call the distribution. They are what we call the distribution. You see it, all these tiny things. Now this is for a downtrend. This is for a downtrend. Now the distribution phase is actually trickish. The distribution phase is actually trickish. If you are not careful, you fall prey in the distribution phase, and then the market makers will take advantage of you. Now you see these small cells is the problem. Even though they give us good prediction for us to buy again, but they are very trickish. Phase is always quite trickish. You need to understand it very well, else you you actually go the wrong direction in the market. So that is where there is what we call the stop point. We have what we call the false breakout, etc. Now this just to trigger the little investors, which are the retail traders, so that they can take the wrong direction, thinking that it's actually a breakout. So watch it out. Then the next phase is actually our markdown phase. Now the markdown phase happens when prices drop fast as selling overwhelms the buying. When selling overwhelms the buying, we see a markdown phase. For example, look at this. Now the same thing happened when we have the markup. We are seeing it happening on our markdown. You see, now the selling here is actually a markdown period. Is a markdown period. The selling here is what we call the markdown. Now the markup is going up, bullish, while the markdown phase is what is selling, bearish, is selling. Now for each of these markdown and markup, you discover that the same thing always happens. There is what we call the accumulation and distribution. That is what we call the accumulation and distribution. That is what we call the accumulation and distribution in the markdown phase. Now price drop fast as selling overwhelms the buying pressure, as selling overwhelms the buying volatility. So now for you to be able to trade, you look for a short selling opportunity and then get it with different confirmation for you to be able to trade. Now don't just rush and enter the market because the price is what is selling. No, that is what most people usually do. Now we have many indicators for us to understand the price have changed direction totally. Now let me see if I'll be able to put some indicators. Okay, I'm covering the aspect of the indicator with a video. Okay, I'm put it like this. Now let me put the indicators. Now I want to use the trend indicator. Okay, one of the trend indicator here is the Ichimoku. Now many people, maybe I will do a special video on this. Many people don't understand this Ichimoku very well. Many people don't understand it. Now look at this. The moment you see price touching the history, is telling you that there is a pullback. When price is touching the history, it's telling you that is what a pullback, trend pullback. It's telling you that it's coming back to test either a resistance or a support zone. That is how this Ichimoku works. This histogram here, you see it, this histogram. Now price is coming to touch it. It's actually a sign of what? Of a pullback before the major trend. Now after the pullback, you will notice that there will be major trend. After the pullback, there will be major trend. Now look at what happened here. after a pullback many times, there was a major trend, and that is the major food you will look out for to eat. Look out for. Now this, you see, now it has crossed finally with this particular candlestick. Now it has crossed. I'm not supposed to do this in this video because I'm beginning to teach you Ichimoku now. You see this pull back to this point. Look at what happened after the pullback. Look at how price move continuously. Now let me stop that, please. Let me focus on what I'm here for. Now this is one of the ways for you to confirm. By what? By using indicator. Now this is an indicator. You can use this indicator for you to understand the direction of the market. If it is below, if the history, the Ichimoku history is below, it means that there is actually what? Change of trend. And then if you look at the color of the Ichimoku also, look at the color of the Ichimoku, you discover that there is change of what? Like change of trend. Now that is that for that. One of the easy indicator for us to use is our moving average. Moving average 200. Now you use it on exponential. Change the color to yellow. And now shifting it anyway. Now when price is above it, is what you look for bullish movement. When price is below it, is what? Bearish. This is bearish. I see it is what? It's bearish. Okay. Now see it clearly. Now this alone will tell you it's actually a confirmation whether you are in a markup or you are in a markdown. This will help you to confirm your trade. Now this is one of the way I use to confirm my trade. Now I have many ways, but let me just leave these two indicators to help you to confirm your trade: the Ichimoku and your moving average. Now I want to move this training further a little bit so that we can be able to get deeper knowledge. So I want to move it a little bit further. Now I want us to understand something from this principle that the Wyckoff actually gave us. Now we have what we call the composite man, which represent the collective action of institutional investors who aim to own the market. That's what we call the composite man. Now the actions for institutions to own the market, to say this particular market is their own, is what we call the composite man. Now everybody want to own the market. That is the truth about it. Everybody want to own the market, but one of the criteria for you to own the market is actually having a lot of equity. But if you don't have a lot of equity, you can still own the market by understanding how the market moves. Because if you can understand how the market is, how the market moves, you will be able to follow the institution in order for you to trade very, very well. So that is what we call the composite man. You need to understand that the composite man, the collective actions of institutions, investors, market makers, who aim at what? At owning the market. You can actually join them, but understand their moves, and this is just their move by understanding so when you understand the phase of the market, you are now also a composite word, a composite man, because you'll be able to own the market to yourself. Now that's one of the reasons why I'm doing this video. Now the core principle focus on reading price action. The core principle focus on what? Reading price action. We're talking about candlesticks formations. We're talking about the volume of demand and supply. You know, now when we talk about candlesticks formation, we're talking about the different ways in which candlesticks display. Now you see this particular candlestick, see this one is the abandoned baby. This particular one is the abandoned baby. We have the inverted hammer, we have the hammer. Now we have this, we have the inverted hammer too. So you see we have different types of candlestick formations. We have different kinds of candlestick formation. There are candlesticks that prove to you or shows you that there is weakness in the market is about to reverse. There are candlesticks that shows you that there is strength in the market. When you see long candlestick, is actually a proof that there is what we call strength in the market. Volatility, momentum. Look at something like this, you discover that there is volatility, strength in the market. Now when you see such kind of thing, you should always be careful. Why? Because if it is not in direction of the trend, you might get stuck. Now why we are trading this is because it's in direction. You see it's below the 200 moving average, so we are trading it what? Downward. We are trading it downward. But if you look at this now, after such kind of move, immediately begin to what? Sell. Why? Because this particular move is against the trend and it need to go in direction of the trend. Remember, the trend is always your friend. So now when you are going against the trend and it is big move, you need to be what? You need to be careful. Now look at this particular candlestick here. This particular candlestick here that does not have a wick is called the marabuzu. The marabuzu kind of candlestick. Marabuzu kind of. This marabuzu is actually proof of strength in the market. That's one of the strongest candlestick that you can see that will depict to you strength in the market. Look at this also, marabuzu, showing you that there is strength in the market. This particular candlestick is marabuzu, showing you that there is what? There is strength in the market. So now you need to understand this, and then you need to understand supply and demand. You see here, you need to understand supply and demand. You need to understand supply and demand. You see here, supply and demand. See, you need to understand supply and demand. Area of supply and demand. Yeah, I have done a video on supply and demand already. I have a video on that. Please watch, look for the video in this channel. Look for the video and watch the video, because it's actually a great asset to you. Now after doing that, you need to watch the price and know if it is in accumulation phase or it is in distribution phase. Now before you will trade. That is one of the knowledge that you need to have as a composite man. Watch if the market is in accumulation phase or distribution phase before you enter the market. Before you enter the market, then you need to spot fake breakout. We call them spring, false breakout. Look at them, false breakout. You see this, false breakout. You think that it has broken up going for a buy while it is still downtrend movement. False breakout. See it, false breakout. Now watch for what? False breakout. See, you see them spike and just false breakout while it is in a downtrend. False breakout. Now these are false breakout. Look out for false breakout. breakout that is not true is called false breakout. Breakout that are not true are called false breakout. So look out for false breakout, and then use your spikes candlesticks in order for you to know rejection of prices. Also use for what? Use spike candlestick. Now, how we do trade now? You need to understand the trading strategy in this aspect. Now, you need to buy when there is actually sign of strength after accumulation. You need to buy when there is actually sign of strength, when after your what? After your accumulation. That is when you buy. You see buy, this is a proof of strength, rejection of low prices, rejection of low prices. See this particular candlestick, you see complex confirmations. Now with this, you'll be able to what? You'll be able to buy. You click on what? You go for a buy. You see, now you have started going for a buy. Why? Because you have seen a clear confirmation. After what? After an accumulation, you saw this candlestick formation, rejection of low price, and then you begin to what? You begin to buy. The same also happen when you want to what? Sell. Now look at here. Here is actually a support zone. Here is actually a support zone. After a support zone, you saw rejection of prices. It begin to what? Begin to buy. Now let's look out for a sell. Let's look out for a sell pressure, because it seems as if I'm focusing more on a buy. Now look out for a sell. We started selling what? Started selling at this particular place, but before then we saw what? We saw the same accumulation happen here. Resistance. We saw a resistance here, and then there was a fake breakout. We saw rejection of high candlesticks, rejection of high prices, rejection of high prices, and then here comes this word, the sell. After the sell, look at what happened. After the sell, look at what happened. Look at what happened. Now price went back for an accumulation here, showing us what? A support, which was broken. Look at the movement. The big movement started with what? Heavily. The movement started heavily after the breakout of this particular word, support. This range, support and resistance, this is a range. After this range, it break down heavily and continue to move down. Now we have all indicators here. Rejection of high prices, we have rejection of high prices, and all those are entry points, for us to continue the trend. Now with this strategy, you'll be able to monitor and understand how to tackle the market with the whole of your mind, because you understand this particular secret of the market maker cycle of Wyckoff. Now the Wyckoff chart, the price there is actually marked detailedly alongside the volume stage with what? With four phases which I've explained unto us: the accumulation, the distribution, the markup, the markdown. Now you need to understand these phases. Now the first phase, which we call the accumulation phase, now is to stop the previous trend. If you notice, the first phase is actually to stop the previous trend. After stopping the previous trend, then the phase B, which is the second phase, is to build a course. That's accumulating or distributing what? Shares. Is to build what? A course. The third phase is to test supply or demand, whether they're going for uptrend or downtrend. It will test it to know. Then we have the markup or the markdown, which is our buy or sell, it begins to happen. And lastly we have the trend acceleration. And the trend acceleration is the last thing that we see in the Wyckoff trading. Why? Because that is where people make money. That is where you see gold flying up and down because of what? Acceleration. The strength is very heavy, that cannot be compared with anything. Now this is what we call the trend word acceleration. Now we need to understand this. The first is that we are stopping the previous trend. The second is that we are building a course, that's accumulation or distribution. The third is that we are testing supply or demand. And then the fourth is our markup or markdown, that's the movement, the starting of the movement, the trend movement. And then we have the trend acceleration. After the trend has been known, the trend direction has been known, we have what we call the acceleration, the speed of it. Now for example, now this is downtrend, we all know. This is our markdown. Then look at the acceleration. This falling is the acceleration. Look at this falling is the acceleration. This is a pure acceleration. You need to put it at the back of your mind. This is pure word acceleration. The fall. Look at this massive acceleration. Look at this massive acceleration. Massive acceleration is happening on all pairs. This is happening on all pairs. Massive word acceleration happening on all of the pairs. So we need to analyze our volume. We need to know the phase that we are, so that we won't be able to enter the market wrongly. So if you enter the market wrongly, you'll be in a haste to leave the market, and you being in a haste to leave the market is a proof that the market is actually on you. The market is benefiting from you, and our agenda is for us to be ahead of the market, making profit. That is our agenda. So now I've come to the end of this video. The market cycle by Wyckoff. The market cycle by Wyckoff. Now I just want to do a little summary, and then we close. Now as regards the phases, we just discussed. We discuss about the accumulation phase, we discuss about the markup phase, we discuss about the distribution phase, and we discuss about the markdown phase. And when we talk about the market behavior, we talked about institutional buy, we talk about rising demand, that's an uptrend, and then institutional word sell, and we talk about selling dominance, that's downtrend. We talk about price action, sideways range. We talk about testing of support and resistance. We talk about higher highs and higher lows. We talk about sideways range, which also implement lower lows and lower highs. We also talk about volume behaviors. We talked about some key Wyckoff patterns, which is actually a spring, which has to do with the first breakout. We talk about accumulation, consolidation. We talk about the price breakdown, and then we actually did the strategy on how we can actually use this to trade. So thank you so much for watching this video. Kindly subscribe this channel, and do well to share. Thank you for watching.
Thank you for watching this video. Do like, share, comment, and subscribe to this channel for more information.